Hello everyone, welcome back to Upside Down Data. Today I want to talk about comparing the UDPI to the RSI in a simulated backtest. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you've been following the channel, you're familiar with our upside downside potential indicator. It's our risk indicator here on the channel. The idea essentially with the UDPI is that once you get closer up to 5, that's high risk. That's what these kind of red points are. This is the price history of Bitcoin color-coded as a UDPI level. And you can see that when it flashes red, that tends to be at these topping out points. It's down in the green, that tends to be these bottom points, these good accumulation zones that tend to precede these moves to the upside. And I recently put out a video where I showed a multi-UDPI trading strategy, and I just basically simulated what results would have been from that strategy over time. So for example, one of the simulations I looked at Bitcoin and Ethereum starting from beginning of 2019. And the strategy was basically that you'd be looking at the two different UDPIs as time goes on, and if it happens to be the case that, as Bitcoin becomes more risky, and if Ethereum happens to be less risky at that time, you'd be taking profits off of Bitcoin, moving them into Ethereum, and vice versa. If Ethereum was higher risk or high risk at that time, you could move that profit into Bitcoin. So this dynamic strategy would be moving from a high risk asset to a low risk asset. And what I found in that simulation was essentially that strategy would have outperformed the market. That if you had done that, you would have beaten someone who had just bought and held Bitcoin and Ethereum. And that was, I think, kind of notable because, of course, early 2019 was a great time to be buying either of those assets. They both appreciated massively. I think it's notable that this multi-UDPI strategy beat the market, even when we essentially gave that comparison one of the best entry points they would have gotten in recent history. But one of the questions that I got on that video, which I think was an astute question, was, okay, but do we need the UDPI for this? Couldn't we just use the Relative Strength Index, the RSI, which is freely available everywhere? It's been around forever. Is the UDPI actually breaking new ground here, or is it able to beat the RSI? So could the RSI just replace the UDPI in that kind of strategy, or is the UDPI able to outperform the RSI when you're doing that? So that's what I want to talk about today, comparing this kind of dynamic multi-asset strategy based on the UDPI, comparing that to a strategy that's based on the RSI, see which one does better. So first off, I do just want to note, I'm not going to show this in this video because I've shown this in a bunch of the previous videos. I'll leave a link to that previous video I was mentioning in the description if you want to go check that out. But one of the things that I've shown in previous videos is basically that the UDPI is able to generate this kind of output in real time. So it's not a model that's doing this requires hindsight. So the UDPI can produce the same output or better actually in real time as to what you're seeing on the screen here. So this is just the UDPI with full knowledge of Bitcoin's price history. Turns out if you just simulate this over time with only giving the model real-time knowledge, so it has no knowledge of the future, it'll produce basically the same kind of output. So it's reliable in real time. And that's the output I'm going to be using when I'm backtesting or simulating these strategies, right? I'm not going to use the output that has knowledge of the full history. I'm going to use the output of the model when you run it with only the knowledge of like the given day and everything before that day. So if you want to see more about that, go check out the previous video I put out where I go into more detail. But essentially, this is not subject to hindsight bias, and I'm going to be using the data as it would have been existing on the literal days of these simulations. So just a note there. So if you've seen that previous video, the strategy that I basically simulated was this one. So essentially, we have here the UDPI level here, what you're going to do, are you going to buy or are you going to sell at different levels, and then the amount that we're going to do it. I'm going to have the comparison be starting, all the comparison conditions are always going to start with $40,000. So this is just kind of rough numbers that might make sense if you're starting with that amount of money. This is all kind of just off the cuff. I don't necessarily think this is an optimal strategy or anything. It's more just a proof of concept is the way that I see it. So essentially the idea is that the lower the UDPI level is, the heavier that you're going to be buying per day. And then the higher it gets, especially after it breaks above 0, then you're just going to be selling increasing amounts every single day. So that's the way that this strategy is going to work. So buying increasing amounts as the risk level falls lowest, selling increasing amounts as it rises highest. So the way this is going to work, so for this strategy, I decided to just change it up from the last one. You know, with back tests, it's nice. It's good to vary around things a bit just to gain more confidence that there's nothing idiosyncratic to one specific starting point or something like that. So I just bumped things back about 6 months. So we're going to be starting in beginning of June 2018 rather than the beginning of 2019, which is what I did last video. And we're going to use that same kind of testing strategy. So this is going to be that UDPI-based DCA strategy using that schedule I just showed you of how you'd be investing, or how the person would be investing this who's using this strategy. One thing to note is I did multiply those values you saw before there. I did multiply them by 10 by the time we get to the top of the 2020-2021 bull run. And the reason for that is just that you're playing with so much more money at that point that you would want to increase the amount of money that you're moving in and out for this kind of strategy. It wouldn't make sense to still be moving in and out $100, for example, if you've just gone and ridden this massive explosive move to the outside. You'd want to be making more use of the capital that you've gained. So that's why I've done that. And I'm using the long-term UDPIs for Bitcoin and Ethereum. That's another thing I should clarify. We're going to be comparing Bitcoin and Ethereum in this simulation. So just trading between those two assets. And so for what I'm going to show you first is just comparing this to a buy and hold strategy, and then down the line I'll compare this to a RSI based strategy, but I'll get to that in a minute. So the way that the buy and hold strategy is going to work is just on this specific day they're just going to buy in $20,000 worth of Bitcoin, $20,000 worth of Ethereum. The DCA person is just going to start with $40,000 on the sideline that they'll then invest based on this DCA schedule. So that's the way that the setup is going to work. All right, so let's look and see what happened with this. So this is what the weighted DCA total value is. So just basically the total value of the money they have on the side, the Ethereum they have, and the Bitcoin they may or may not have at a given time. The total value of those three things is what's represented on this white line. And of course it does quite well, right? You know, starting at that point, you know, you're sitting up just a bit under $400,000 here, starting for 40,000. So about a 10x move up over that time. Not too shabby. And that beats the market. So if you had just bought and held that $20,000 worth of Bitcoin and Ethereum at this point in time and just held it over time, you would have been outperformed by this weighted DCA person. This strategy would have been outperforming someone who just bought and held over that time. And we can overlay some other lines here to get a better sense of what's going on underneath the hood of this weighted DCA strategy. So what I'm showing you is in green, this is the amount of cash that this weighted DCA person has on the sideline or has on hand. So you can see they're quickly DCAing into the market at the beginning. And then in that kind of run up we got in 2019, they're taking some profits and then readjusting. So they're actually selling some Bitcoin and buying some Ethereum. You can actually see that here, where the blue line, this is the Bitcoin value that they hold. The pink line is the Ethereum value they hold. You can see they're selling Bitcoin and buying Ethereum during this time here. So they're just rebalancing their portfolio based on the current risk levels at the time. So then they more or less are holding their positions, a little bit of adjusting that's happening in between here, but nothing too major. And then we go into the big parabolic phase where they're starting to take a lot of profits off of their Bitcoin position and potentially moving some of that into their Ethereum position. And then they're starting to take profits off their Ethereum position as we get into the summer, then reinvesting into both Bitcoin and Ethereum here. And then as we went on that second kind of run that we saw coming out of the summer, then they're taking more profits off the top there from both assets, both Bitcoin and Ethereum, and then reinvesting now, and they've actually been reinvested back into the market, or would be reinvested back into the market at this point. So they're holding, you know, some Ethereum and some Bitcoin, and then their total value is above what this person would have been at. So pretty nice. So the weighted DCA person would have had almost $400,000 at this point, $384,000 versus $214,000 for the buy and hold person. And so this constitutes a almost 80% increase in ROI using the weighted DCA strategy over just the buy and hold. So that's something that seems very much worth one's while, right? You know, some people might say, oh, well, what about taxes? Well, taxes probably aren't going to take up 80%. You know, the highest tax bracket in the U.S. is like 37%, I think. So this will still be well worth your while. You know, this is still, you're going to be left with significantly more profits than just this buy and hold, even when you account for something like taxes. So this is, I think, definitely shows the utility of this kind of approach, that even just trading between Bitcoin and Ethereum, you'd be outperforming the market by almost 80% over this time period. So that's pretty notable in my opinion. But now the question of the video, right? So this is all well and good, but what about the RSI? What if you just did this based on the RSI instead of the UDPI? So let's see. So this is going to be the RSI level, so 0 to 10, 10 to 20, 20 to 30, 30 to 40, etc. And so if you're not familiar with the Relative Strength Index, it ranges from 0 to 100, although it's not really ever going to hit these extreme values based on the way it's calculated. It would be, but it tends to just kind of range between these. And so 50 is the center point. So then I just to be similar to the strategy I use for the UDPI, whereas 0 is the midpoint of the UDPI, we're just going to cut off at 50 for the RSI. And then the exact same values on top and bottom. So they're literally the same strategy, you're just replacing the indicator that we're looking at. So when we look at the RSI results, so we're comparing it here to just a buy and hold strategy with the same setup as before, right? So buy and hold 20,000 Bitcoin and Ethereum. RSI person just had all their money on the side and it's investing based on the RSI level. And if you just look at it, it's dismal. The RSI just does not do well at all. Like, just look at this. It's almost kind of just sad how bad the RSI does over this time when the underlying assets exploded so high to the upside, right? You know, the RSI strategy is only just breaking 50,000. That's only about a $10,000 profit over this whole time from that $40,000 starting cash. Nothing compared to what the buy and hold was able to do, right? And if we just look under the hood of what's going on, I think we can kind of see the issue here. So again, cash, the different values. The problem is that the RSI tends to get faked out during big explosive moves to the upside and gets worked up too quickly if you're using it like a risk indicator. So essentially, it'll explode to the upside with just small moves to the upside. That's what happens here. The RSI really pops up here, which we know is super early from the peak of 2019. But if you're just using the RSI, you would just have sold off at that point, and it never dipped below 50 in the meantime, so you never would have reinvested until after that run had ended. And then same thing with this parabolic run here. It gets freaked out too early and just has you sell your Bitcoin and Ethereum way before the move is actually played out. And so you're just sitting on the sideline with all this cash, not able to profit on these moves to the upside. And so that's really kind of the issue with the RSI kind of approach, is that it gets faked out too easily by these big kind of explosive moves. And that just ends up making it a not very useful indicator for this type of strategy. It will not be able to provide you the kind of information that you need to be able to execute this effectively, essentially, because it gets freaked out too quickly. And really the reason for that is kind of baked into the way the RSI is calculated. The RSI only takes into account the past 14 days, so it's inherently decontextualized. It does not take into account an asset's full history when it's assessing relative strength. And really by its name, it's not even supposed to be like a risk indicator. It's Relative Strength Index. It's supposed to be telling you kind of the relative strength of this move based on what's been happening recently. And so for that reason, you know, the RSI will oftentimes get overexcited at the beginning of parabolic moves if you are trying to use it like a risk indicator. And so it's just really not fit for that use case at all. And we can see that just in these results here as well. And so this would have netted you 76% lower ROI than if you just held your assets. So not a very auspicious showing for the RSI. And if we compare it to the weighted DCA, we can see the weighted DCA would have had a 659% higher ROI than a weighted DCA strategy based on the RSI. So quite disparate in their results. You know, weighted DCA or the RSI, daily RSI is not going to be a good idea. It's just not going to work out very well. And the weighted UDPI strategy though would have worked out. It would have worked out very well, you know, almost 80% above the market. I think that's quite notable. And so that's really where I see the value of the UDPI, is that it's not decontextualized. It understands the whole history of the asset up until that point, and it's making its risk assessments based on what it knows about the asset's entire history, what it's done its entire history, and basically the UDPI learns from that entire history and is able to assess risk in context. In context, what it's seen that asset be able to do in the past, or how it knows the asset has behaved or tends to behave in the past. The RSI doesn't do that. It's by calculation, by definition, a forgetful model. It does not care about the entire history of the asset, only very recent history. So the UDPI is able to kind of blow things out of the water there. Now, the one thing I do want to also just address here is that one of the questions that might have come up is, okay, if the daily RSI sucks, then why not use the weekly? I think, you see a lot of people talk about the weekly as being kind of more of the risk indicator-esque version of the RSI, right? Like the daily RSI isn't so much supposed to be, or isn't all that useful, and we see that here. It's not all that useful as, kind of this more risk-based thing, or trading on it, treating it like an indicator like that. But what about the weekly? Because the weekly sometimes people talk about as being more effective. So I did just run a quick simulation where I did check that, and it turns out the weekly does actually do a lot better than the daily, for sure. If we look at this, so this is just looking at the same time period, but trading based on the weekly RSI, not the daily. And it looks like it actually does outperform the market over that time period, which is notable. So 30% increase in ROI. But of course, that's nothing. That's small in comparison to what the UDPI was able to do. It's less than half of the increase of ROI than what the UDPI was doing. So even though it does do better, it's still not as good as UDPI-based strategy. And again, part of the reason for that is it is still a forgetful model. That even if you're caring about the past 14 weeks, that's not a whole lot of time relative to the whole history of Bitcoin or something like that. And so the other thing I want to talk about as well with the weekly RSI is one of the places that can really rear its head, that kind of forgetfulness. It's not so much in these really quick, sharp parabolic moves like what we saw during this period of time we were just looking at, but where it becomes an issue is these kind of building parabolic moves like this, where if you look at the weekly RSI over this time period, I'm just showing you a screenshot from TradingView here. If you look at the weekly RSI over this time, look at how quickly it gets freaked out way too early, right? It's telling you to get worried all the way back here in mid 2016, way before the top, way before the top. Imagine if you'd sold your Bitcoin, you bought Bitcoin here and sold it here, only to watch it go parabolic all the way up to here, right? Selling, under $1,000, and then watching it go up to almost $20,000. You're not going to want to do that. That's terrible. That's not going to help you at all. UDPI does not do this. The UDPI over this time period only spikes up to high levels of risk at the actual top. It stays much, much lower before then, and it is not giving you super high risk warning signs at these points. It's only once you get to the actual top that it spikes. And again, that has to do with the UDPI not being forgetful. The UDPI learns and it contextualizes risk. The RSI only contextualizes things in the period that you've told it to consider. So for the weekly RSI, that would be 14 weeks. For the daily RSI, that's 14 days as the default. Now you can change that N around if you want to, but then it just changes the meaning of it. But for the stock kind of weekly RSI, it would just be 14 weeks. And so it gets fooled essentially during these kind of movements, whereas the UDPI doesn't. And so I think that's just another advantage of the UDPI over the RSI, is that it also just seems more robust to handling diverse market conditions, whereas the RSI can work well in some market conditions, but less well in others. And so you kind of have to get lucky and just have market conditions play out in a way that's suited to the RSI working well. You'd be kind of out of luck if you're using the RSI and something like this were to happen. And so that's where there's kind of that uncertainty, whereas the UDPI handles both of these situations great. It handles both of these very well. So just another note between them. So I do want to just end this to say that I don't think the RSI is a bad indicator by any means. I think it is useful. I just don't think it's especially useful as a risk indicator. The way I think of the RSI is more of a momentum indicator, to get an idea of how strong the movements are relative to kind of recent history, and then getting an idea if each kind of subsequent move is stronger or weaker than the preceding one. Because if you're getting weaker and weaker moves, that tends to suggest that momentum's leaving the market. If it's stronger and stronger, might mean that momentum is building in the market. And so that's the way that I look at the RSI, and I don't personally see it as being all that useful for this particular type of strategy. I think the UDPI is way better suited for this type of strategy, and we just saw that in the data. You run these simulations, the UDPI outperforms the RSI. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, we're all going to make it.